Welcome to another episode of InvestorPool, a carpool series that's all about real estate, finance, and improving your knowledge. Also about giving you the skills from these experts we bring on to improve your income. Today I'm actually joined by Tuan Duong from Duo Tax Quantity Surveyors. Tuan is actually an award-winning founder of a quantity surveying business and someone who I feel will really be able to give you guys a lot of knowledge about tax, depreciation, and how that comes together in the world of property investing. Tune in as I speak to Tuan about his story, his journey, and tips for investors like yourself. Tuan, thanks for joining me, mate. Welcome to an episode of InvestorPool, and I'm just, keen to share with a lot of the listeners out there, watchers, all about, you, the business that you're running, and also your thoughts on things about property and depreciation. So, might start off with just, getting to know more about you, I guess your story and how you started Duo Tax.
Sure thing. Thanks for having us, Arjun, today. And first time doing carpool tax depreciation. So thanks
Making it fun, right?
Yeah, that's exactly right. So just good to catch up with you. But I guess a little bit about myself. So my name's Tuan Duong. For the viewers out there that don't know, I run a company called Duo Tax Depreciation. We're quantity surveyors based in Sydney, focusing on tax depreciation services Australia-wide. So our initiative is to ensure that we go out there and serve investors that are trying to, I guess, make the most of their investment properties through a tax tool known as the depreciation, I think, claims on any rental property. So with the ATO back in 1997, they've allowed investors to claim depreciation on any rental, residential or commercial rental property. Right. Now that is eligible for taxpayers. So I guess with us, we've started the business about 3-4 years ago, back in April 2015. And we've gone on to just specialise in the tax depreciation field. It's
where being the specialist, not the generalist, right?
That's right, awesome. Being the specialist, and myself being a property investor, actually before being a quantity surveyor, my passion has always been in investments. Yeah. And I guess it stemmed from an interest in finding the value of tax depreciation, where I bought a small rental property in Sydney back in 2011, and a tax depreciation schedule back then paid dividends for myself because awesome. That building that cash flow of maybe $1,000 to $3,000 in refund per year would allow me to calculate some cash flow figures that I could, I guess, allow myself to negative gear the property, make the most of my tax, those advantages that are eligible through the ATO, and then leverage for the next property. And I've gone on to invest in other properties through building small amounts of cash through depreciation, better interest rates, having good property to build capital cash flow. And
in terms of investors, right, I'm pretty keen to get your knowledge, help them learn a few things, help myself learn a few things, and bust some myths about depreciation, right?
Sure.
So we're buying a residential property, and what are the things an investor should know, or as in what are some myths that you hear that we can bust just from the depreciation end in terms of property?
Happy to answer that. I've just today alone, I've probably got 3 questions from potential clients that have already asked, and a few of the common ones are: if I've got a really old property, can I still claim any depreciation? The answer is not short, but yes, you can.
Cool.
Now, the ruling last year, 9th of May 2017, the federal government came out with a new ruling that says if you've got an existing property prior to the 9th of May, you can claim depreciation regardless. So the rule has always been that before the 9th of May, if you have a rental property that's built well before 1987, even in the 1950s or 60s, if you've purchased the property before 9th of May 17, you can still claim depreciation on the second-hand plant and equipment. Right. So things like your light fittings, your carpets, your old blinds, your old oven, your old cooktop,
that's definitely a mythbuster straight away, right?
Exactly right. And you could still claim depreciation on those second-hand assets as long as that property was purchased before the 9th of May 2017. So, but however, after the 9th of May 2017, anyone who exchanges contract or purchases the property after that date will no longer be eligible to claim depreciation on those second-hand assets, and that's to it's a housing integrity measure that they've had to bring upon this amendment to the legislation to ensure that people weren't double claiming on second-hand assets. As you can imagine, if you've got a second-hand asset that was purchased in 1950 and we've had five purchases since then, what was happening were people were continuously claiming depreciation on the same asset over and over again, so doubling up, so to speak, on that depreciation. And so the government has stopped that and required a tax invoice or a receipt of sorts to prove the cost of the asset in order to depreciate. So moving on from the 9th of May 17, it must be a brand new asset that's purchased from a retailer like your Good Guys or your Harvey Norman in order to depreciate that.
Gotcha.
Yeah.
So sort of like that. That changeover is important for investors to understand.
It's very
what
important.
They had.
It's very important.
And I've always just wanted to know one thing, right? Where, okay, you might be listening to this and watching this and thinking, well, I've got a property I purchased before that date. Can they still get the report done now, or have they missed out?
That's a great point. Now, reports are always retrospective and they're forecasted. So, retrospective meaning if you've got a property that's purchased 5 years ago, you are eligible to claim depreciation because you're under the old ruling. However, once we create the report today, it is retrospective, so we will start the depreciation from 5 years ago, if necessary, keeping in mind that amendments to your tax return can only be done up to 2 years. So you can only go back 2 financial years from the date of notice of assessment. So for example, if you've done your tax return on the 1st of July 2015, you can only amend that 2014 tax return up to the 1st of July 2017. So you get 2 years from the date of notice of assessment. So you do have that window, but the report can be retrospective, so meaning if you want to raise an objection with the tax office, I believe you can go further back. However, it's not always guaranteed that you will get those tax deductions. So definitely you are able to claim depreciation moving back as a retrospective report, and also the fact that the report is forecast. So even if we create a report from 5 years ago, it will go up to 40 years of depreciation from the date of build. So it's just a single report that you use to claim depreciation.
So people sitting on it really should actually investigate this, because it's almost, just money sitting there, right? In terms of your asset. And
I believe that there has been some statistics that have come out from the ABS that have recognised that only 30 to 35% of residential property investors Australia-wide claim depreciation. So that's a huge amount, considering that every Australian residential investment property was eligible for depreciation up until the 9th of May 2017. So that statistics would be fairly accurate, and unfortunately there are a lot of people missing out. And I guess the sheer fact is because a lot of the depreciation is only claimed if they are advised about it by people like yourself, Arjun, accountants, brokers, lenders. But if they're not given the advice, because I guess the tax depreciation is a cash flow tool that it's a non-cash deduction. So, being that if you don't fork the money out, you wouldn't know that you could claim it. And unfortunately, things like your council rates, your water rates, your buyer's agency fees, they're cash deductions where they come out of your pocket. You can claim a deduction through the tax office. With depreciation, there is no actual cost, because the depreciation is coming it's a deduction that's on paper. It's an on-paper loss. And unfortunately, if people aren't recognising that, they're missing out on that deduction. The only cost to the depreciation report and claiming that depreciation component is the quantity surveyor's report.
In terms of commercial, I think this is interesting, because I'm finding in my business a lot of investors wanting to look into the commercial property end.
Yes.
Understanding that we're in an environment where hot spotting, I guess, across the country is a bit difficult to sort of attain. But then commercials are offering, in this sort of uncertain environment, some very high yields, cash flow opportunities, and in some cases some great growth opportunities.
Certainly.
Laws differ, right? Could
Yeah.
you talk about depreciation from a commercial front?
For sure. I think commercial depreciation has lots more benefits compared to your residential, and I'll explain to you why.
Yeah, interesting.
Firstly, the commercial depreciation is exempt from the legislation rules that occurred
Gotcha.
last year that came into effect.
So was that the 2017 rules you're talking
That's
about
right.
just before?
So the housing integrity measures don't apply to commercial, and that is a great thing. That means that if you buy a second-hand existing commercial property, you'll be entitled to claim depreciation on the whole lot, whether it's with any plant and equipment asset, as well as the building.
So there's so many things that the common investor wouldn't know about that, right? And I
Exactly
think this
right.
is where it just speaks wonders in terms of the power of using the right professionals and just asking for help.
Asking the question,
Yeah.
and then getting
You can
the
never ask
advice.
enough questions, right?
That's
I've
correct.
been asking questions on every carpool, right? That's all I do, and
Yeah.
I learn so much from it.
Exactly right.
In terms of so commercial, correct me if I'm wrong, but does it also in the commercial area the date in terms of how far you can go back differ from residential? Is that something that's there?
probably something that it's definitely something that you would want to consider, because it does have a little bit. I think it's 1982 to 1984 has an accelerated depreciation rate of 4%,
Right.
and then from 1984 all the way through to currently, you'd be eligible to claim at 2.5%. So with depreciation on residential properties, it's limited to 1987.
Interesting. So
September.
I guess on
Yep.
the commercial front, what you're saying
get-
now is that there's a split between the times,
Correct.
but then B, there's also some additional, legislation changes that haven't impacted, commercial.
That's
As
right.
well as, I guess, some extra parts that you might not have in terms of the scrap and a few other areas that happen as well.
Correct. Yeah, there's definitely some large advantages with the commercial side, given that the flexibility of fit outs and being able to claim those as scrap values has a big impact, and also the fact that owner occupying a commercial space, you're also entitled to claim depreciation, whereas when you owner occupy your own home, there's limitations and you aren't allowed to claim deductions.
See, I
on
didn't
those.
know that, right? So just
Yeah.
sitting with you today,
Yeah.
I'm learning something new around that. That's
'cause
awesome.
You'd be seen as running a business outside of that commercial premises. Another I think big legislation act that's just come in. There's been an amendment to the GST Act,
Right.
And that GST Act is to cover a lot of people are buying rental properties, residential rental properties, investment properties that are fully renovated, refurbished. And because of the new legislation, it says that if you've got an existing property, you purchase an existing property, even though these assets were brand new, because it was owned by the previous owner, you are no longer eligible to claim depreciation on that brand new oven that was
Right.
purchased by someone else. So this new GST Act that has just come out in the last month or two now allows the residential property investor who buys a fully renovated property to now claim depreciation on those second-hand assets.
That's
and
fantastic.
that is a big win
Yeah.
for investors that are buying stuff that is generally newer and has I guess the capacity to generate a lot more cash flow because of that plant and equipment. Because plant and equipment, although it only represents about 10% of the construction cost, that 10% is claimed within the first 5 to 10 years, rather
So it's
than
bigger
over the
first,
40,
yeah.
rather than the 40-year depreciation of the building life.
Right,
So
right.
it's a huge advantage for people buying brand new, I guess, fully refurbished, renovated investment properties, and that would be really applicable to people buying, especially in Newtown, the inner west. These properties usually
They've
undergo.
been older, right? But
That's
they've gone
right.
through their renovation. I think I actually had a recent moment, literally just yesterday,
Yep.
with one of your staff members, Andy.
Yep.
So I'd actually had a couple customers recently in the works of some offers, and I was just saying, you know what? It's the bill date. We're assuming straight away there wasn't any depreciation.
Yes.
But I thought I'd try my luck. Just doing the right thing in terms of, hey Andy, could you check this out? Mm-hmm. And all of a sudden, we've got some of these claims because of these new laws that have just
Exactly
kicked
right.
in,
Yeah.
and the customers are getting surprise phone calls from me saying, "Hey, this is the potential."
Yeah.
So it's thanks for sharing that. In terms of the depreciation space, people might be considering during these times where they're like, "Okay, maybe I do want to buy, don't want to buy. I'm not sure. I
Yeah.
might want to start renovating my place."
Yeah.
I think that renovation can be a powerful tool to really help you with, I guess, value creation where possible, depending on the market as well.
Yeah.
But at the same time, I think it might be important for them to consider the depreciation impact.
Yeah.
For renovating, when you're thinking of the biggest positive impacts in the space of depreciation, where should investors place their attention?
When renovating a property, it's the greatest amount of depreciation is always going to come from areas that require plumbing, tiling, and anything with relatively high amount of detail, and that would include any wet areas, your bathrooms, your laundry, kitchens are the most common. I think would be the most effective ways of generating cash flow, and although costing the most, would give it the best look in terms of generating that extra bit of rent. So that would be ideal, and with that, obviously, you're getting new appliances. You've got dryers, potentially, washing machines if that's provided, kitchen equipment, stovetop ovens. They're the assets that are generating the most amount of depreciation, and those are the sort of assets that I think would drive the rent the hardest.
I guess like they're the stuff that you're using every day.
Correct.
You're in and out of. You know, people
appreciate
you
that.
imagine yourself living in there and how you'd use it.
Exactly right. Yeah.
And I think that's some really good points. That's it from us here at InvestorPool and the series here, and from us at InvestorKit. For everyone watching, Tuan is again from Duo Tax Quantity Surveyors and Arjun from InvestorKit. Follow us on Facebook, LinkedIn, YouTube, or Instagram. You can just search up InvestorKit. Thanks for tuning in. See ya.